The stock market closed yesterday, November 4th, 2025, with all 5 of these names landing on the losers list for the day, reflecting some sharp and distinct downward pressures across different sectors. Let's look at the closing figures for November 4th, 2025, which we will use as the last official trading data point before current market opening. Diginex Ltd. DGNX closed at $18.25, a steep decline of negative 22.77%. Norwegian Cruise Line Holdings Ltd. NCLH finished the session at $18.80, down significantly by negative 15.24%. Navitas Semiconductor Corp. NVTS wrapped up the day at $10.46, losing negative 14.61%. Zoetis Inc. ZTS closed at $124.51, a drop of negative 13.74%. Finally, WeRide Inc. WRD ended its session at $9.40, a negative 13.76% fall. These are not just minor pullbacks. These are major, double-digit losses that demand a deeper look, starting with the biggest mover of the day, Diginex, and the surprising context behind its massive drop. The immediate expectation when you see a stock like Diginex plunge over 22% in a single session is that some catastrophic, company-specific news must have hit the wire, a major regulatory setback, a product failure, or perhaps an emergency capital raise. Yet the real unexpected insight here is that the sharp move may be driven by a confluence of factors tied to its low float nature and its recent history, rather than a singular, fresh disaster. Diginex is an impact technology business focused on environmental, social, and governance (ESG) and climate issues using blockchain and machine learning. Now, that is a compelling mission, and the market narrative for DGNX had actually been quite volatile but recently bullish, with the stock having traded up from its 52-week low of $0.45 to hit a high of $39.85 not long ago. The general belief is that ESG-focused tech is a secular growth winner, aligning with massive institutional mandates and growing public pressure. The reality, however, is that this stock has an extremely small share float, meaning a relatively small amount of selling volume, even from a single institutional exit, can trigger an outsized cascading price drop. Looking closer at Monday's trading, the heavy volume combined with an earlier reported sell rating from Weiss Ratings in early October likely created a perfect storm. The narrative is high-growth ESG. The reality is an illiquid, highly volatile stock prone to violent swings on low-consequence events. This DGNX movement is a clear example of why individual investors need to understand the concept of float when they are self-investing and not just focus on the appealing story. While the company's core business of providing transparency in corporate social responsibility and climate action remains important, the stock's price action is less a reflection of its societal impact and more a function of market microstructure. For those who trade individual brokerage accounts and manage their own online investing strategies, watching the trading volume on a day like Monday relative to the average volume offers a crucial lesson in liquidity risk. The recent institutional purchase by Y-Intercept Hong Kong Ltd. in Q1 suggested some smart money saw long-term value, yet even that wasn't enough to stem the tide of Monday's sell-off. The key is that the volatility in DGNX, given its fundamentals and sector focus, is a warning sign that the technical picture currently overshadows the business model. Moving from specialized tech to the world of leisure, we find Norwegian Cruise Line Holdings Ltd. posting a stunning negative 15.24% loss on Monday. The common expectation was that NCLH, like its peers in the cruise sector, was finally putting the lingering effects of global health crises behind it and riding a wave of pent-up consumer demand. We saw positive reports about strong consumer demand and increased bookings, with the company even raising its full-year adjusted EPS guidance. The reality that crushed the stock was a crucial revenue miss in its third-quarter earnings report. While the company beat the EPS forecast, reporting $1.20 versus an anticipated $1.16, the revenue of $2.94 billion fell short of the $3.03 billion expectation. For a debt-laden company in a capital-intensive industry, especially one that has endured such a prolonged period of operational disruption, revenue growth is the ultimate proof point for the recovery thesis. An EPS beat that is achieved through cost management, while good, is viewed with skepticism if the top line, the actual sales coming in, is faltering. The market essentially said, "We believe the demand story, but we need to see it in the raw sales figures to justify this valuation." This highlights the tension between two common investor strategies: the growth camp, which prioritizes increasing revenue above all else, and the value camp, which looks for earnings efficiency. In NCLH's case, the growth camp sold off the stock because the revenue wasn't strong enough. The stock's current momentum rating is negative, underscoring this pressure. We are seeing a real-world stress test of the cruise line's significant debt burden, where every revenue report becomes an acute focus. This sector's fortunes are closely tied to consumer discretionary spending, and macroeconomic pressures like inflation and interest rate concerns, the same forces that influence individual decisions on whether to use Fidelity, Robinhood, or Interactive Brokers for their personal investing, can quickly translate into booking anxieties for cruise lines. The heavy insider selling reported throughout the year further compounds investor caution, as large sales by management often suggest a lack of conviction in the near-term stock price trajectory. The analysts who follow the sector remained largely optimistic, with 80% maintaining a buy rating, but the average price target of $8.05 is significantly below the stock's closing price of $10.46, indicating a significant disconnect between analyst models and the market's enthusiasm for the stock's long-term growth. The immediate focus shifts to whether the company can truly hit its projected Q4 2025 revenue bottom and demonstrate the promised growth in 2026. This kind of high-growth, high-volatility name is exactly the type of ticker that appeals to the active trader on platforms like Robinhood stock trading, but it underscores the risk inherent in smaller-cap, transitional technology plays. The semiconductor space, which includes giants like NVIDIA stock, is intensely competitive, and any misstep in execution can be immediately punished. Next, the animal health giant Zoetis Inc. saw a surprising drop of -13.74%. The general expectation for Zoetis is that its business is highly defensive. People spend on their pets and livestock regardless of most economic cycles, giving the company a stable and reliable revenue stream. The recent news has been largely positive. An EPS beat, $1.70 actual versus $1.62 forecast, operational growth in both companion animal and livestock portfolios, and EU clearance for a key cat osteoarthritis treatment. So why the sharp sell-off? The unexpected reality, the thing the market pounced on, was a very minor revenue miss of only $10 million, $2.4 billion reported versus $2.41 billion anticipated, coupled with a slight downgrade to the full-year revenue guidance. This almost obsessive reaction to a minimal revenue miss is often a sign that a stock is priced for absolute perfection. When a stock trades at a high valuation, as Zoetis does, any crack in the perfect growth story is treated as a major structural flaw. The market, in essence, is re-rating the stock from an ultra-premium valuation to a slightly less premium one. The pain was magnified by weakness in the U.S. segment, which, despite achieving 3% organic growth, saw a reported decline of 2%. Investors often prefer to see clean, double-digit growth stories to support these kinds of valuations. The Zoetis stock decline also coincided with a broader rotation out of defensive growth and into other areas, and this high multiple stock became a source of funds for institutional investors. The company's business model is robust, developing, manufacturing, and marketing animal health medicines, vaccines, and diagnostic products globally. They are a leader in a stable, growing industry. The long-term thesis remains intact, but the short-term technical reality is that the stock had gotten ahead of its near-term financial execution. The dividend yield is modest but consistent, which appeals to a different class of investor than the hyper-growth hunters. This stock is often held in a Schwab Intelligent portfolios or through a Fidelity mutual fund, valued for its stability. The sharp price cut offers a lesson. Even the most defensive growth stocks are vulnerable to severe technical corrections when they fail to meet the market's sky-high growth expectations. The market's laser focus on the U.S. revenue